Welcome back to JPX Energy Market Weekly Updates.
Fears of an economic slowdown are getting much of the blame for the big sell of last week. After prices slumped to the lowest level since the March banking crisis, crude oil futures rebounded sharply on hopes that the United States rate cycle will be paused, and a stronger than expected U.S. labor market report dampened fears of a weakening U.S. economy. Nonetheless, the market still poised for a third straight week of losses, with JPX Dubai July contract trading at around 62,700 yen per kiloliter, or $73.90 a barrel, while the more liquid September contract was trading around $72 a barrel. Intermonth spread largely remains steady as OPEC supply cuts kicks in. The Federal Reserve hiked rates by 25 base points at its latest meeting, bringing the target rate up to 5.25% on the top end. The market hopes the current rate cycle will be paused, although initially remain under pressure as concerns of the banking crisis and U.S. debt concerns linger on. The crashes of several banks in the United States seems more serious than the 2008 and 2009 crash. The problem at the time was bad mortgage loans. Debtors were unable to pay and were defaulting. This time, these banks' investment had no such default risk, since most money is invested in U.S. bonds and other low-risk securities. The loans made to governments are fundamentally built on faith. The Treasury can always pay by rolling over their debt, issuing new bonds at the current rates, what will be called lifting the debt ceiling. However, pandemic borrowing has driven U.S. government debt to unprecedented levels just as interest rates rise to fight inflation. As the interest-bearing debt grows and tax revenues, the only source the Treasury would have to pay interest on the debt, dampened. The market believes the default risk in the future is increasing. There's a fear that drying up the liquidity of the U.S. bonds would exacerbate the collateral discounts of the bonds and weaken the refinanceability of the banks, and eventually lead to a broader banking crisis. As U.S. Treasury debt is the benchmark used to price other domestic debt, that would result in increasing borrowing costs and further impact the economy. History is clear that even getting close to a breach of the U.S. debt ceiling would cause significant disruptions to financial markets. Take another look at the oil market fundamentals. Most market analysts still expect oil demand to rise during peak air travel and driving season. Gas oil and petrochemical feedstock weakness might be counterbalanced by growth in gasoline and kerosene, thus contributing to an overall growth in oil demand. European diesel cracks post first weekly gain in 7 as stocks at main ports fell to a 13-week low from their elevated pre-Russian sanction levels. During the Great Recession of 2008 and 2009, diesel demand fell by around 10% in some European countries, equivalent to the proportion of European diesel supply that come from Russia before the war. So the drop in consumption is likely to be outpaced by constraints on supply as Russian imports dry up, supporting European diesel margins in the rest of the year so long as the Great Recession does not occur.
Okay, that's all we have for this week. Welcome back next week.